value for us is a broad tent. We're willing to buy a more mundane asset that doesn't have a lot of growth, but really has a prudent price and prudent management team. And we also love, on the other end of the spectrum, buying franchise companies that have the ability to grow 4, 5, 6% a year generationally, but at the right price. And that's a huge universe for us to look at. But there are subsegments of the market that we tend not to delve into. And I think, the analogy, I think, is that of the tennis court. And if you think of First Eagle, we tend to stick within the singles court, as opposed to going into the edges of the doubles court when we think of the game of investment tennis. And that singles court is very broad already. But if you think of the fringes of the market, there are a range of companies on one extreme that are statistically cheap, but they don't have valuable intangible assets. In fact, they might have contra assets, if you will. They might have subscale market position. They could have R&D that's been disrupted. They could have tarnished brands. And these could be businesses that are in structural fade, and they may be paired with management teams that don't think like owners, that aren't accepting that fade with grace and taking the cash out of the business, but are perhaps trying to diversify in a haphazard fashion. Think of the decline of Eastman Kodak, for example. So we try to keep away from impaired businesses that are statistically cheap, but have agency issues. On the other end of the spectrum are the kinds of stocks that we were just talking about, the concept stocks that are essentially bets on the future, but where there's no line of sight to the arithmetic working between the current rate of growth and the cash flow today. And the problem with those edges of the universe, or the doubles court, if you will, is that the valuation for those kinds of companies is option-based. You're either a call option on survival, if you've got an impaired market position, or you're a call option on the future. And what we know is that most options expire worthless. The option value is based on volatility, and it has a negative expected return to it. On the other hand, if you think of the companies that are in the center of the tennis courts, that are cash flow generative, often they're more attractively valued for the very reason that they don't seem to embed a lot of optionality to most investors. They're seen as too mundane. But if that gives us the ability for the arithmetic to make sense, that's fine. And I think one of the reasons value investing has done well over the very long term versus growth is that the market overpays for optionality.